So I've got a little checklist up here, and these are the main 4 points, or 3 points I should say, that I want you to understand. So the first thing is trend. At the end of the day, what is the overall trend? Because at the end of the day, the trend is your friend. Now we can see just from looking at this bit of price action that we are clearly trending to the downside, right? Just by utilizing this trend line, and not using the trend line in the sense of how you traditionally use a trend line, but just being able to see that we're creating lower highs, lower highs, lower highs. So we're looking for sales. Once we've identified the trend, it makes it much easier for you to in line with the markets and where you should be going. So if I come out to the daily time frame, we can see that this spike up here that we had on Monday, we came into this fair value gap on the daily and then reacted and fell to the downside. In hindsight, it's much easier to see this, but the mindset that you need to have when trading is to understand where most people want to be buying, or where most people are afraid to be selling, is where you want to be selling. And we understand that you want to sell high and buy back low. You don't want to be buying when price is running here. So a lot of people will be seeing this bullish move, 2 bullish days, and thinking, oh well, you know, we should be looking for buys, and that's where they get it messed up. So if we take this range from this high, right, this high here to this low down here, we can see, if I pull from there to there, right, that we are above the 50%. So Fibonacci retracement tool, these are the settings for the Fibonacci: 0, 1 and 0.5. Essentially it's 100%, 0% and then 50%. The basics of premium and discount is anything above 50% is classed as a premium, and anything below is classed as a discount. So when you're trading, you want to be selling price when it's expensive or premium, and buying price when it's cheap or at a discount. Looking at this leg here from this high to this low, right, and to identify highs and lows, it's very simple. It's a 3-pin formation, or 3 pattern, 3-pin formation, what I was taught, or you can just look at it as the middle wick is higher than the other 2. So essentially the middle wick here, or the middle candle, is taller than the candles to each side of it. It's just a 3 candle pattern, that's it. And this candle here is shorter than this one, and this candle here is shorter than that one. Just like we have here, this candle shorter than this one, and this candle shorter than this one. So that there is also a swing. And just like down here, that's shorter than that, and that's shorter than that. So that's another leg. So that's just how I identify swings and highs. So when you pull the fib from the high to the low, we're getting a range, a kind of measurement of this range from here to here. Now all it's saying is this is a 50% retracement, or this is 50% of this range. So it's bang on halfway of that range. So when we're above halfway of the range, it's classed as premium, right? And when we're below halfway of the range, it's classed as a discount. So hopefully that's kind of cleared up the premium discount. So understanding that we're clearly in a premium, right? If I now put these lines onto here, and I just mark this off as the daily fair value gap, and I mark this off as the daily fair value gap. When we jump onto the lower time frames now, we can see that price is reacted, in hindsight, has reacted perfectly to this daily fair value gap, and then it's fallen off, right? This daily fair value gap top is also an order block. So you've got a lot of confluences within here as to why price could fall off. So not only is it in a premium where you should be selling, it's also wicking into a daily fair value gap, which is a strong level, because we know the higher time frames have more authority over the lower time frames, and also we're tapping into now a 4-hour order block. When we come onto the hourly, well, I'm gonna stay on the 4 hours and quickly just mark this off. So I'm gonna pull this to here and pull this to here and refine it a little bit more. So we now know that this is now turned into a 4-hour fair value gap, and this one as well is also a 4-hour fair value gap. So when we come to the hourly time frame, you can clearly identify the ranges again by using the same formation, 3-pin formation, right? We've got the first candle, the candle lower, and then the candle shorter, like this, right? Just there, that's one, and then we see the other one is up here. So when you just look through the charts, you can see multiple, right? We've got here, we've got one here, we've got one here, we've got one here, and here, etc. Now, if we look at when price actually came up, right, from here after we created that high and price dropped off as it does, and then it starts to consolidate throughout Asia session, coming into London session, coming into New York now, what do we see? Well, we see at the 9:30 open, that price spikes right back up. It just misses the 4-hour fair value gap and then instantly falls off and just crashes. Now, the similar thing I did on the daily, right? So let's go back to the daily. The similar thing I did on the daily, pulling the Fibonacci from the high to the low, is the exact same thing you want to do on the hourly time frame now, right? And by the way, the same thing is happening on each time frame. It's the market's a fractal, and the same thing you see on the daily, you'll see on the weekly, you see on the 5 minute, you see on the 1 minute, the 5 second. It's the exact same thing. So this process can be replicated onto any time frame. And once you just understand the process and the current trend, etc., and then you're in a premium or a discount, you'll be able to see it happening on all time frames. So the same thing's happening. I'm pulling from the low to the high or the high to the low. It doesn't really matter, right? If I now pull this fib from the high to the low, it doesn't matter. But we pull from one point in the range to the other point in the range, and we now identify where is price currently. So we know that from the daily, we're already inside a daily fair value gap. We're already in a premium daily level. We're now at a 4-hour fair value gap as well, and more refined, because remember the daily fair value gap bottom was actually here. We look at this at 9 o'clock, look how we respected that daily fair value gap level and then dropped off. But to keep the charts a bit cleaner, and what I'll do for now is I'll change the colours of this. I'll make it a little bit thinner. We can see that we've respected the daily fair value gap, the 4-hour fair value gap, and now as we're pulling back up, we're also now pulling into a 1-hour fair value gap. So if we go back to our notes, so when we look at the notes here, right, what is the trend? Bearish. So tick, we're looking for sells. Where can price potentially turn around? Well, we've already identified where price could potentially turn around. That's the 4-hour, which we turned around here, the daily fair value gap. Now at 9:30, we also have to see where could price potentially turn around. We then look at this hourly fair value gap, as this is a point where price could turn around. Now, if you're an hourly trader, or you like a swing trader, you could say, or you like to trade on a higher time frame, there you go, you've already got your entry. In a higher time frame premium, right, remember that, we're above the 50%, so in a higher time frame premium, we've tapped off out of the daily fair value gap and the 4-hour fair value gap. Now we've got an hourly fair value gap, 4 confluences already showing you that, you know, price is most likely going to drop to the downside. So for you entering off the hourly, that's an entry right there. We stop loss just above the swing high there. You're targeting the lows here or anywhere below here under this sell side liquidity, and you could even be targeting down here. Now that's more, I'd class more of a swing trade. If you want to refine, you could have a bit of a tighter stop loss, and you could have put it above this 4-hour high and above this wick high, and that would have brought you a better return. But if you wanted to get a bit more of a refined entry, or you wanted a little bit more of a confirmation, what we can also do is pull out the Fibonacci again and mark off this range that we're now seeing. So we're now seeing this range in here, from this high to this low. So pull the Fibonacci again from the high to the low, and we can see that at 9:30, price pulled up above the 0.5, so into a premium again, or just on this smaller range, into a premium level again, tapped into not only a fair value, hourly fair value gap, also an hourly inverse fair value gap here, where you could have got a bit more of a sniper entry with your stop loss above here, and yet again targeting back down at the 50s, or if you wanted to extend it back down to the range low down here. Jumping in onto the 30-minute time frame, we can see that the hourly inverse is also lined up perfectly with the 30-minute inverse. So there isn't much more confluence or much more evidence you need to be looking for sells. And that's one thing with when it comes to trading, you've just got to, when the market is showing you its hand, you've just got to take the trade. Because if you don't take the trade, it's going to run away from you, and then you're either going to get a much worse fill and either have to risk more or risk having a tighter stop loss where price could potentially pull back up into here, prop up one more time, and then drop down. And that's not where you want. You want to be entering at the most premium area, right? Now, in this case, right, this is the best entry. personally, in my opinion, this is one of the best entries you could possibly get. Moving on to point 4, entry points and exit points. You don't only use premium and discount for entries, you can also use it for exits. So if we're selling at an expensive price, you want to be buying back your sales at a cheap price. That's why my first target is always the 50%, which we also call equilibrium. But anywhere below the 50% is a good area to be taken out, because buying it back for a cheaper price than you sold it. Now you can match that up with, for example, an inverse fair value gap in here. So you can look at that, the way price was consolidating through here before it exploded to the upside, and then taps in and comes back lower, back into that same confluence area, or that same consolidation area, right, in confluence with that inverse fair value gap. Or if you wanted to, I'm on futures right now, so if you're trading with prop firms, you wouldn't be able to swing trade, and if you're trading on your personal account, you would be paying some decent fees for overnight fees. But if that's how you trade, then there you go, you've got a nice hold from this entry here for about 3 days until price came down and took out this low down here. That pretty much wraps it up for the whole video. Quite a simple concept to understand. Once you put the practice in and you start to actually see this day in and day out, you'll realize it's a very, very simple concept, and you can become profitable by simply just identifying swing highs, major swing highs, right, and major swing lows and major swing highs, understanding the dealing range. Are you in a premium or are you in a discount? And utilizing, the key here, right, is utilizing the higher time frame, the daily time frame, because this whole idea came from the daily time frame, right? And you can see the same thing happening if I pull it from this swing high here to this swing low down here. When price pulled up on this first move, right, and created this swing high here, we're back up into a premium. Even if you just trade on the daily, we've got this gap in here that was filled, and if you was a daily time frame trader, well, you've got yourself a nice beautiful swing trade from this swing high down to the equilibrium and further down into here. So having an understanding of the trend, right, having an area price could potentially react from, fair value gap, order block, or it could be support and resistance, having the confluences to stack on top of that, right, that could be, for example, even a premium or a discount, price is tapping into your area where it could potentially react from. And then on top of that, the timing is also key, especially if you're looking for more intraday day trades. You're looking on timing, and I like to trade either London session, New York session. On the hourly opens, half an hours, because that's where a lot of volume is usually pushed into the market, on new hourlies or new half an hours. A little bit of advice you can take from this is also think of point A to point B, right? All your trading is from point A to point B. That's it. Everything in the middle is noise, and this here is no man's land, right? You are not trying to trade in no man's land, because that's when you get chopped up in the ranges and you get faked out here, and if you don't know how to trade ranges like that, you're just going to get chopped up, right? So think point A to point B. Think you're a detective. You need to find out as much evidence as possible as to why you think the trade is going to go in your favor. And if you coop all of them together, so trend, area of reaction, the confluences, and then your entry and exit points, you will see much more success, less losing trades, and more success in the markets. So if you enjoyed this video, got a bit of knowledge from it, make sure to subscribe, thumbs up, also leave a comment down below any questions I've replied. See you in the next one.